let's go through the markets really quickly, and then what we're going to do is we're going to stick to the application side of this. What we did last week was what a corporate finance department would do for a major corporation or an investment banking division for a major bank would do. So today what we're going to do is the same type of application of theory in corporate finance. And what we're going to do is you are going to be the investment banking division for Eastdale Secured, which is one of the top investment banking companies in the United States. They're headquartered out of New York, and they have offices in most major markets. This is premier real estate investment banking. One of the problems in the book is it leaves out alternative investments. So it doesn't have really any discussion on real estate, which is one of the largest asset classes in the capital markets. So there's a big gap in the book. So we'll be doing an underwriting today. We will underwrite a $1 billion project in Mission Bay. We will be Eastdale Secured, and we will be working with a company called Alexandria, which is a REIT located out of the East Coast. They're a multi-billion-dollar REIT, and basically they have engaged us to not only do the underwriting for the securities, but also to help them underwrite the transaction. Okay, and we'll see, just based off of our research so far, if the project is feasible as an investment. So let's go back and do the market. So where is the Dow right now? I mean, the market's still open. Is it up or down? And what do you think caused the market to go up or down? I don't even know.
It's down 0.92%.
Okay. Any news on why the market would have dropped today? I mean, there was a bunch of news over the last 20.
Wells Fargo.
You got it. Senior of Wells Fargo left. Okay, that's going to have an implication on the marketplace, either positive or negatively. Wells Fargo Bank in total market capitalization is a significant portion of most major stock indexes. Okay. Anything else in the marketplace? Anything in regards to interest rates or?
There's supposed to be an earning recession for 6th straight quarter.
Okay, that's a good one too. Profits for and earnings growth for the S&P 500 has been declining for how many quarters now?
6 straight.
Like 6 straight quarters. Okay. And are we in earnings season right now? Yeah, we're in earnings season right now. So I don't know who's on the docket today to come out and release their earnings.
But don't most of them report next week, right?
Yeah. Some do early. Most of them will do it next week. And do they announce their earnings during the market hours, or do they usually do them after hours? Yeah, they usually do them after hours because they don't want to impact the stock price or create any kind of panic selling. And when you hear the earnings releases, they will tell you if the earnings have met or beat or underestimated analyst expectations. Okay, and that will have a big impact on the stock price. If they met or beat or did not meet or beat analyst expectations. Okay, what about oil? Where's oil trading right now?
50.45.
50.45. Is it up or down?
It's up 0.54%.
Okay. I thought it was trading down a little bit. I know it was trading up because the Saudis had basically got everybody together to negotiate a oil production cut, which has caused the oil prices to be propped up. And then the Saudis basically said that the Russians are probably not going to cut back the production that they said they would, which is probably what's driving the price of oil up. What about gold?
12.59.
12.59. Is it up or down?
Up.
It's up. So the question is why is gold up? Any reasons why gold is up?
Because of the dollar slipping.
So we got devaluation in the dollar.
The stock market's continually flat or going down.
Okay, so we have pressure from the stock market. People are selling off the stock market and going into safer assets such as gold. And we probably would see the yields on the treasury go down too as people move from stocks into bonds. What is the 10-year treasury yielding right now?
1.73.
What is it?
1.73.
1.73. You don't need to follow me on this. 1.73. Okay. Is it up or down? So it's down. So that confirms that. So if interest rates are going down, then bond prices are going up. Okay. And then what about foreign currency? That's been a big deal over the last 2 weeks, and particularly for this week. So what's the exchange rate, dollar to the pound? That's really
1.22.
1.22, and has the dollar appreciated or depreciated against the pound?
Depreciated.
So it's depreciated against the pound, so the pound's appreciated? Okay. And what has the pound done over the last 2 weeks? Has it appreciated or depreciated? This is kind of a big deal.
Depreciated.
It's what?
Depreciated.
It's depreciated by how much? Can you calculate the depreciation, of the pound against the dollar? We talked about it a little bit on Tuesday. It's been written up in the press. So if you check out any of the press releases, they're going to have the calculation of the depreciation of the pound compared to the dollar in the last 2 weeks. So I got a few numbers because we did this in the last class. And I've read some articles over the last 48 hours. Did you have the calculation? Did you come up with something?
No.
Anybody have it? It's been between 15 and 18%. Okay? 15 and 18% depreciation in the pound, which is a major move. Okay? And then we're not going to go into the euro and stuff like that because we just don't have time. Because it's going to take the whole period to do the exercise. All right. So you are the investment banking division, the real estate investment banking division for Eastdale Secured. Again, one of the top investment banks in real estate. Okay? And that's who we work for. And we got a call from Alexandria REIT, okay, and I'll go through those guys in a minute. But you may want to go ahead and pull up Eastdale Secured's website. So it's Eastdale, BIL, and you also want to pull up Alexandria REIT, and the company's website is www.are.com, okay? And you may also want to go ahead and access St. Mary's library for online databases to get access to Morningstar and Value Line and Standard & Poor's and any other access that you can get financial information on this company. Okay. So Eastdale Secured, again, is one of the top investment banking companies in real estate in the United States. So they are the premier, and actually they're owned by Wells Fargo. Okay, but they're a totally separate company. And we specialize in basically 6 lines of business, and we're full service. We do very large institutional property sales brokerage. Okay, most of our transactions are in the $20 million range and above, which would be considered institutional. So we do brokerage. We also do debt placement. So today what we're going to do is we're going to do a $1 billion project. We're going to underwrite it on behalf of Alexandria. They want us to take a first stab at it. And we're probably going to finance the development using Alexandria's debt. And we're going to issue some debt, but we're going to be the underwriters on the debt. Okay? And we're going to distribute those debt securities through our distribution networks. So we're going to underwrite the debt, and we're going to distribute it. And we're also underwriting the transaction. So this is a huge consulting contract. We also do investment banking. We're not only going to raise some debt to finance this project, but we're also going to raise some equity. So we're basically going to underwrite the equity securities, and then we're going to place the equity securities and distribute them through our distribution network, our broker-dealer network. We also do private equity. We raise funds, raise capital, closed-end funds, and co-invest with institutional investors in these closed-end funds. So we also do public equity, but we also do private equity. We also do structured joint venture contracts where we basically pull in different investors and invest in single assets. So we can raise the equity through different partners, and then we can buy the properties and then lever it up, because we also have a mortgage banking division that we have. We also do corporate real estate transactions. A lot of the corporate real estate owners may want to sell off their assets at some point, so we can broker the deals. And they might want to lever up their real estate by taking out mortgages on it, because then they can lever up the property, pull money out of the property tax-free, and use that cash to expand their businesses. A lot of these corporations will also do sale leasebacks, where they will sell the property and then lease it back from the new owner. we advise on those transactions too. And then lastly, we have a mortgage banking division also, and structured finance. So basically we can go in, we can look at the properties that these people own, and we can figure out how much debt and how much mortgage they can put on it, and we will actually go ahead and originate the loan, okay? We can originate first mortgages, we can originate second mortgages, we can originate mezzanine financing, so we can do the whole capital stack for our clients. And really no other investment bank does that. We compete against Goldman and JP and Citi and the top 5 major banks in the US, the top 3-4 banks in Europe. And we're just domestic, okay? We just operate domestically, we're not international. We focus on certain types of products, real estate product types or property sectors. We're involved in office, hospitality, hotels, retail, multifamily, industrial R&D facilities, and land. And this deal that we're doing today is a biopharmaceutical product, because the product that we're building, or helping them to build, is a 1 million square foot biomedical facility with medical office and labs in Mission Bay in San Francisco, right next to USF, okay? And our client, again, is Alexandria REIT. It's a very large REIT, highly respected, high quality product, works with corporate clients, but also will be involved in developing product for its own account. It will hold the assets on its balance sheet, and it will finance the assets using a line of credit, or will issue debt and equity to pay off the loan and hold the assets themselves. They may actually co-invest with pension funds and endowments and other large institutions if it makes sense for them to do that. So they build a very high quality, highly respected company. And you can see from the picture, and it's going to be coming up in a minute, I'll show you the project that we're going to do. And it's going to be a 1 million square foot medical office, research labs in Mission Bay, in San Francisco, next to UCSF, which will probably be one of our biggest clients, along with other companies that want to be close to the university, and also to exploit the intellectual property and the patents that are coming out of UCSF. So I'll show you the project in a minute. Okay, here it is. So this is Mission Bay right here. There's 280. There's the ballpark. There's going to be a development there. There's the housing. And this is the commercial space. USF is over here. And then our project is going to be over here, which is going to be about a 1 million square foot campus. Okay? So you get an idea of what we're trying to do here, or what they're trying to do. And we're going to advise them on it. So the first thing I need to do in the underwriting process is to really go back and really assess the capability of Alexandria to be able to do this type of project. Can they do a $1 billion project? So what I need to do is to figure out how big Alexandria is first. So can you give me what the total value of the assets are on a historical cost basis using the 2015 annual report? So you go up to the Investor Relations tab and you start clicking on the 2015 annual report. You go look at some of the press releases, you go look at the 10K, and also you can use Yahoo Finance, Morningstar, S&P, and any other sources to give you the information that I need right now to be able to do the underwriting in less than an hour and 30 minutes, okay? So you are going to be my research team, okay? And you're gonna need a calculator. So pull out your calculators, because we're gonna be running a bunch of numbers. So how big is Alexandria? What's the ticker again? What's the ticker? What's the ticker again? ARE or ARC?
ARE.
What is it?
ARE.
ARE? So how big is this company? I need to figure out first as the lead underwriter, I'm the lead underwriter here and here, the underwriting team. I need to figure out right off the bat how big this company is and can't take down a $1 billion project. Because if you can't do it on its own, I'm gonna have to find some other investors to co-invest, so we'll end up syndicating the deal. Okay, but I don't wanna do that. So how big is the company? Give me the total dollar amount of the assets in 2015. That's probably the best number to use right now. If you go up to the balance sheet should be in the annual report, should be in the 10K, the most recent 10K will be there, which will give it to you. And you probably have the most recent numbers are probably the second quarter of this year, because third quarter probably hasn't been announced yet, or the numbers haven't been done. So what's the total size by assets for this company? Any luck? And if you can try to find also not only the value of the assets, but you're gonna need the balance sheet, because we're gonna have to figure out the capital structure. And I would be interested in seeing and hearing what the total value of the debt is outstanding and the total value of the equity is outstanding, which would be considered the total market capitalization for the firm.
Total assets are 8,911,000.
What?
8 million.
No, it's not, it's in millions, so it's probably 8 billion. Okay.
911,120,000.
Okay. Yeah. We'll just round that. So basically, almost $9 billion company. Is that a big company? Yeah. Do you think that they could handle a $1 billion project? Do you think that they could have an exposure of 10% of their total assets in one project?
Yes.
Yeah, totally. Because it's a super project, high quality tenants, best location in the world for one of these developments, in Mission Bay, supply constrained, next to UCSF. I mean, come on. And they own the land, okay, already. They're the master developer of Mission Bay. So this totally makes sense for these guys. All right, so give me so if the assets are 8.911 billion, what are the liabilities?
4.6.
Under the matching principle. Under the matching principle, it's the total liabilities. You got it. So 8.911 billion, right? Are the total liabilities. Now tell me what the composition of the total liabilities are from the historical cost basis. How much is owner's equity and how much is debt? And if you want to combine, I'm not sure if they have any preferred stock, but just add the preferred stock to the common stock. It's usually immaterial in most cases, but it's theoretically correct that you would take the preferred stock and add it to the common equity, okay? So what's the breakdown of the liabilities by debt and equity? If you got the liability, if you got the balance sheet up, you should be able to figure that out pretty quickly. What is it?
Well, your total debt is 3.97 billion.
All right, and then 3.97 billion minus, taken from 8.911 billion, what do you get for the equity? You can just plug the equity. If you know what the total debt is, then you can just subtract it from the liabilities, and that's your equity. So how much is it? What is it?
4.94.
4.94 billion. Now give me the percentage, give me the capital structure. How much is equity, how are they financing their assets? This is gonna be the current. Are you using 2015 balance sheet, or are you using the 10K?
2015.
Okay, cool, so this is the current capital structure. Okay, and what's the percentages? Can you calculate the capital structure for me? So it's this divided by that, or that divided by that. I need the percentages, because we gotta calculate the weighted average.
44.6.
Is that, that's the debt? that the debt? Okay, and then what's the equity? How much is the equity? 55.4, okay. So just right off the top, is this company conservatively leveraged? Is this company under leveraged or over leveraged? Based on the current capital structure, is it over leveraged or under leveraged? Does it have more or less debt than equity? How are they financing the assets? Are they using more equity or more debt? Issuing more, they're using more equity. Is equity more or less expensive? Is equity more or less expensive?
More.
It's more expensive than the debt, okay? So it doesn't make sense that they would be using a higher cost of capital to finance their assets. And their equity is a higher proportion of their capital structure than the debt. REITs overall, real estate investment trusts, are conservatively leveraged. They're usually around 50-50, okay, if you look at them. And what we would probably do if we had more time is we would go look at the capital structures of the peer group, the direct competitors, and compare their capital structure to the peer group capital structure. So right here, you can see that they're conservatively leveraged. They're probably under leveraged. So do you think that they could take on more debt? Could these guys take on more debt?
Yes.
Yeah, they could. And is debt more or less expensive?
Less.
It's less expensive. So these guys are under leveraged, and they could lever up the firm to lever up the return on equity if they wanted to. Okay, so that tells you something right there. Their competitors' capital structures may be 50-50, but I would bet that their target capital structure or their optimal capital structure is probably 60-40. It's probably 60-40. These guys are under leveraged. Because you want to have more of your capital structure in debt, because debt is cheaper, okay? Because you can deduct the interest on the interest payments on the bonds. And they have the bonds have the first claim on the earnings. And they have, if they ever go into bankruptcy, the bondholders have the first claim on the liquidation of the assets. So this company is conservatively leveraged. So the problem's going to be is when you're calculating the weighted average cost of capital, do you use the current capital structure or do you use the target capital structure? Okay. Theoretically, you use the target capital structure. Okay. You want to write these notes down. Okay. Because a lot of this stuff is in the book, but you're going to skim over it and you're not going to remember it or you're not going to even see it. Okay. So theoretically, what you would do is use the optimal target capital structure when calculating the weighted average cost of capital. What we're going to do is we're going to be more conservative, and we're going to use the current capital structure to be able to calculate the weighted average cost of capital. Okay. Oh, what is the current stock price right now? What's the current stock price? What is it?
104.
104. And then what is the funds from operations per share? Because for real estate investment trusts, we don't use earnings per share, we use funds from operations per share, or FFO. Funds from operations is also called FFO. So that's the free cash flow that we use, okay, when valuing the securities. So that's what we look for. So can you find me the FFO per share either for 2015 or a trailing 4 quarters using the second, first, fourth, and third quarter of last year? So the second and first quarter of this year added to the fourth and third quarter of last year on a quarterly basis to get the annual FFO per share. Okay? Because what I want to do is I want to divide the FFO per share by the share price. And actually what I want to do is I want to divide the share price by the FFO per share to get a multiple and to get a cash flow yield. Because I just want to see what the what the yield is, the cost of equity and the return that they're giving their investors. Any luck on the FFO per share? It should be in the press release. It should be in the annual report, should be in the 10K. If you're on Yahoo Finance or Morningstar,
You want
then
it for a quarter or overall?
I need a trailing quarter from the second quarter of this year or the annual in the annual report from the 2015. The material difference isn't going to be enough, I just need a proxy to be able to move forward.
So you're looking for FFO attributable to?
If you have the total FFO and you divide by the shares outstanding, you can come up with the FFO per share. Or they'll report the FFO per share, and they'll probably be in the press release.
The FFO per share for 2015 was $5.25.
Was it? Okay. So it's 525? All right, so what's 525 divided by 104? What's the cash flow yield on this thing?
5.05.
What is it? Okay. So let's just say 5%. So that kind of gives you an idea of what this security is yielding. And REITs are special. In 1960, Congress passed the Real Estate Investment Trust Act that basically said that if the REITs paid out more than 70% or 70% or more of their earnings to the shareholders, they wouldn't have to pay any corporate income tax. Okay, so they gave them preferential treatment. They don't pay corporate income tax. Okay, so let's figure out we already got the capital structure, we're gonna use this, so now we gotta figure out the cost of capital, okay? Because when we calculate the weighted average cost of capital, we can use that as the discount rate to evaluate the project that you guys have done all the research on. Oops. Cost. And we want to get the weighted average cost of capital, or the WACC. Okay. All right. So let's start with the cost of debt. Oh, can you look up and find out what the bonds for Alexandria, what they've been rated by the rating agencies? You can give me Moody's or Standard & Poor's ratings. You should be able to find that. And that'll give us an idea of what the cost of debt is. Because obviously the cost of debt is going to be really cheap if they're rated AAA, but I doubt they're rated AAA. Probably lower ratings. They're not junk, I mean, it's a really good company. So I don't think that their rating's going to be AAA or anything.
It says AAA.
Yeah, but that's not right. That doesn't seem right, and I'm not going to believe it. If things, as you start to learn this stuff, if it doesn't sound right, it's probably not. Okay? And if it doesn't sound right, you want to do the investigation to find out why. And do the rating agencies or do the reporting people ever make a mistake in the communications? Can you take, financial statements that are reported at face value? You try to, but do you think they ever make a mistake? Yes, they do. So if it doesn't look right, it's probably not. Okay, or something weird's going on. Anybody else find any of the ratings? Again, S&P may have it. The Morningstar report.
Moody's said BAA2.
What is it?
BAA2.
Okay, BAA2. BAA2. Is that a AAA rated bond? Is a B an A rated bond?
No.
Okay, so it's not an A bond. It's a B bond. It's probably like a B minus, right? So what is the S&P ratings? What's the S&P ratings? I just want to confirm what the ratings are so that we can figure out the cost of debt, because we're going to issue we're probably going to issue, I don't know, we'll use this capital structure, we're probably gonna issue $446 million worth of debt if we use this capital structure. Okay, so what's the S&P 500 ratings? We know it's not AAA, we know it's not junk, so we know it's not B, so it's gotta be somewhere between AA and probably double B. So what's in the middle of AA and double B? No, we're using S&P ratings. It's AAA, double, you can figure this out. AAA, double A, triple B, double B, B. We know it's not below double B, right? And we know it's not AAA. So what's the midpoint? Probably somewhere in between. What would that be? What? It's not A, okay, maybe A, what's underneath A? What is it? Triple B? Did you find it?
No.
You didn't find it? Anybody find it? Okay, it's triple B. Actually, you have to understand the class before you found the information. So if I'm giving you information, I'm giving you stuff that the class before you and last night found. Okay, so you gotta find this stuff. Okay, so we got triple B. All right. So how do we come up with it? How do we calculate the cost of debt? And again, it's really easy to go through this exercise if you took really good notes on Tuesday. It's gonna be really hard or impossible to do it, to solve this stuff unless you have a photographic memory. Which if you didn't take notes, you do. Right? You do. Okay, so what is the cost of the debt? How do we come up with the cost of debt? How do we come up with the cost of the debt? Okay, how do we come up with the cost of the debt? We're gonna run out of time, okay? Before the risk premium.
Risk-free rate.
Risk-free rate. So the first thing we're gonna do is we gotta come up with the risk-free rate, right? And I know that these buildings last for 30, 60, 100 years. But let's assume a 10-year holding period, okay? So what risk-free rate would we use?
10-year.
The 10-year treasury. Excellent. So let's go talk to Moody's Analytics. Let's go talk to our research department. Let's talk to the capital markets group. Let's go talk to our in-house and out-of-house economists and ask them what their forward interest rate forecast is for the 10-year treasury for the next year or two. Because we always want to be using forward-looking stuff. So obviously we're going to go back to the yield curve. And why don't you give me the yield maturities on 30-year, 20-year, 10-year, 7-year, and 5-year bonds. So what we'll do is we will construct the yield curve, and we will use what is called, you can actually go to the Federal Reserve Board of Governors. We'll give you the interest rates by maturity so you can get the term structure, and then you can get the most current period for me. Okay. So we want to get the yield maturities. And you can just tell me what they are. I need the 30, the 20, the 10, the 7, and the 5. Because what we can do with those short-term interest rates is we can do a geometric average. To calculate what is called the term structure of interest rates, which will allow us to be able to forecast a forward curve and to be able to forecast the forward risk-free rate. Is our goal. I'm not hearing any numbers. You're the research team. You should be yelling out numbers to me. And this is how it's basically going to work in these meetings. If you're not yelling out numbers to me and everybody else, you're probably wasting everybody's time and they'll ask you to leave, okay? Because we need people who are going to be engaged in feeding us information so we can solve this problem really quickly. If you're not giving us information, then you're just wasting time. So it's like, we will probably ask you to leave, okay? If you're not engaging and adding value to to the conversation. So what's the yield to maturity on the 30, the 20, the 10, the 7, and the 5? What?
Is it for today's, like?
Just give me today's, because what we're gonna do, what I will probably do is I'll probably go back and I'll run the term structure of interest rate calculation for the geometric average using the short-term interest rates to forecast the forward 10-year treasury rate, because we wanna do a forecast of the 10-year.
So 5 is 1.31,
1.31,
7 is 1.6,
1.6,
10 is 1.79,
1.79,
and then 20 is 2.19,
2.19, and what's the 30?
30 is 2.51.
2.5, okay, is that correct?
I got this off the
Is that right?
treasurer's.
Yeah, okay, I need verification validation. Okay. All right. So theoretically, if we calculate the geometric average of these short-term interest rates in an upward sloping curve, we're gonna calculate the term structure of interest rates, and we'll be able to forecast the forward curve and the forward 10-year treasury yield, okay? So to make things easy, right now, the 10-year treasury is 1.8, and the 20-year is 2.19. So this one is gonna incorporate more inflation expectations into it and be more of a forward rate. So let's just use the 20-year treasury as a proxy, as the forward rate for the 10-year treasury, okay? So let's just use, 2% to make it easy. So it's more complicated than this, but this is like the easiest way to do it. So we'll just use the forward rate, which is the 20 for the 10, okay? So we got 2%. So now what do we do? Now what do we do? Remember, we're constructing the cost of debt. Yeah, we're gonna do the risk premiums. What's the most important risk premium? Yeah, credit default. And what's the ratings on the bonds? Currently, if we were to issue some bonds, what rating would we probably get on them? What would be the ratings on the bonds? Because the ratings are a reflection of credit default, okay? So what's the current rating on the current bonds that have been issued already? What's the ratings? Triple B, okay. So is there more or less credit default in a triple B bond compared to a triple A? Is there more or less credit default in a triple B compared to a triple A? More, okay. So is the risk premium gonna be higher or lower for a triple B compared to a triple A? It's gonna be higher, excellent, nice job. Okay. Oh, and I forgot to tell you, I did some research, I looked in the Wall Street Journal, and they told me that the average, for the S&P 500, the average rating is triple B for the S&P 500, and the average yield to maturity on those bonds currently are 4%. So that basically gives us a floor, on what our cost of debt estimate is gonna be. What's the next risk premium that we're gonna figure out?
Maturity.
Maturity. Okay. And the next one? Illiquidity. Now, these guys don't go, overseas and do international stuff, so there's no foreign exchange risk premium. And we really don't know what the outcome of the election is gonna be, so we're not gonna forecast tax policy risk premiums. In real estate revenues, because the leases in these buildings have CPI adjustments in them, embedded in the leases, basically the returns and the cash flows from these properties are inflation hedged, okay? And they plow a lot of money into these properties too, using current dollars to keep them upgraded. So again, real estate doesn't have an inflation risk premium, okay? It's actually an inflation hedge, so there would be no inflation risk premium, although we'll keep the inflation expectations in the risk-free rate, okay? Yes?
Did you add the Forex too?
No, because they're not international,
Okay.
so they're not exposed to foreign exchange risk, okay? So it's really, these are the three most important risk premiums. And the biggest risk premium of all three is credit default, okay? That's the biggest. So if we just use, this, we probably probably know this is the average, right? So the cost of debt for Alexandria is not gonna be the average for the S&P 500. It's probably gonna be higher, right? So it's probably gonna be around 5. Okay? And again, we're just kind of interpolating here. So if the cost of the debt is 5%, and the risk-free rate is 2%, we basically have 300 basis points to distribute across the risk premiums. So you tell me what the distribution is of the 300 basis points across the 3 risk premiums. So what would it be? How would you allocate the 300 basis points, or the 3 percentage points, across the 3 risk premiums, knowing that the largest risk premium is going to be credit default, reflected in the BBB rating? So what is the distribution? Give me the numbers.
1.5.
1.5.
1.3.
Well, let's have rounded numbers to keep the math easy.
1. 1.5.
Okay. It's probably, it's probably close enough, because we are issuing 10-year securities, and they do have illiquidity too, because they're not treasury securities. So let's use this, as the distribution of the 300 basis points for the risk premiums. I just want you to go through that exercise to know that this one's going to be the biggest, and then you'd have to go back and look at the analysis and look at where their bonds are currently trading to figure out the maturity risk premium and then the illiquidity risk premium too. And our capital markets group will do that for us. And we have financial economists that can do that too, and monetary economists that can figure that out. Okay, so now we got the cost of the debt. So give me the cost of the equity. How do we come up with the cost of the equity? What's the equation or the model that we would use to come up with the cost of the equity?
CAPM.
What's it called?
CAPM.
CAPM, CAPM. And what does that stand for?
Capital asset pricing model.
Excellent. So it's the capital asset pricing model. And I'm a proponent of using multiple methodologies to confirm things. So I can calculate the cost of the equity using CAPM, which is the methodology that we're going to use as an investment bank. Most investment banks will use CAPM. But I like to use other methodologies too. You can actually get a proxy cost of equity by using the Gordon growth model and rearranging it. So that's why I wanted to come up with this right here. So if I want to calculate the cost of the equity using Gordon growth, it's going to be the 5.25 over the current stock price is going to give me the yield on the cash flow, the income return. And then that's all I have to do is add some kind of constant growth rate, and I'm going to get a proxy cost of equity. So if we know that this is 5% plus, let's say, 2 or 3 growth rate in the future, we say it's 3, then just by using the Gordon growth model, I can come up with an 8% proxy cost of equity. So I like to use a couple different models. But let's use CAPM. So what's the capital asset pricing model?
Risk-free plus the market price of risk.
Risk-free plus market price risk. And what's the market price of risk?
V times RM minus.
What is it?
Yeah.
So beta times, what is it?
Market risk.
No,
RM.
what's RM? That's okay. And when I'm saying things, I'm using very precise language, so you want to listen to the way I say it. So what's RM?
Expected market return.
Yeah, the expected market return, or expected return on the market. Expected return on the market. Okay, and is that it, or do we need anything else?
What's the risk premium?
Minus the risk-free rate. Excellent. Well, we know that the risk-free rate is 2.0. So we already figured that out. Do we know what the beta is? This is, how big is this company? How big is this company? 9 billion. Is that a big company? Yeah. And it's traded on the New York Stock Exchange. So it's highly correlated to the overall movement in the stock exchange, the S&P 500. We're going to use the S&P 500 as the benchmark to calculate the beta. And so it's a very large company that's traded on the exchange that is highly correlated to the S&P 500. So if it's highly correlated because of its largeness, what would the beta be? Just off the top of your head, what do you think the beta would be? What? Probably 1. Right? But can you look up and tell me what the calculated beta is?
0.79.
Is it? Oh, so it's 0.8?
Yeah.
0.8? So we can use 0.8 or we can use 1. If you want to be more conservative in your assumptions, we can always go back and relax them.
Stu?
What is 0.8? Okay. So give me, what has been the average annual rate of return on the S&P 500 for the last 10, 15, 20, 25 years? What's been the average? And again, you have it in your notes or you can look it up. So what's been the average rate of return on the S&P 500 over the last 10, 20, 30 years? Because the returns are normally distributed, yes.
7%.
You know, the current calculated average return is around 7% over the last 10 years. But over the last 15 to 20 years, 25 years, it's been between 8 and 10%. Okay. So what do you want to use? 7, 8, 9, or 10? Tell me. You want to use 10? 10? What do you want to use? 8? Let's use 8. You can. What you'll do is you'll build the model and you'll run it at 7, 8, 9, and 10. Okay. You'll do sensitivities around this stuff. Okay. So let's just use 8%. Okay. So the market risk premium. Remember, this is the market risk premium. This is the market price of risk. So the market risk premium is 6%. Now you're going to have to do the calculation because you didn't use 1. So what's 0.8 times 6%? And you're going to have to, all of you are going to need to pull out your calculators because we're going to start doing a lot of calculations. What is it?
4.8.
4.8 plus 2, 6.8. So basically, what? 7%? It's rounded up. 7%. So we're getting basically a cost of equity of 7%, and we're getting a cost of debt of 5%. We know the capital structure, we know the weights. Now we can calculate the weighted average cost of capital. Could you throw me that eraser? I took all my erasers.
We have 38 minutes.
Okay. Oh, really? That's it? Shit. All right, so give me the weighted average cost of capital you gotta do real quick. So give me the WACC. How do you calculate the WACC? And remember, these guys don't pay corporate income taxes, so we don't need the corporate income tax sheet. So how do we calculate the WACC?
Can you do max plus the internal rate of return?
No, that's the economic value add spread. I want the weighted average cost of capital calculation. Yeah, the cost of the equity.
Times percent of equity.
Okay, the weight of the equity, okay, excellent. What next?
Cost of debt.
Cost of debt. Well, what would you do, just logically, what would you do now?
Multiply by the percent.
The weight of the debt, all right. So what's the cost of the equity? 7%. What's the weight of the equity? What's the weight?
4.94.
What is it?
4.94.
The weight of the
Oh,
equity.
wait.
What is it? You need to tell me. We're going through that. What's the weight of the equity in the capital structure? What's the weight of the equity? Okay. .554, okay, and what's the cost of the debt? 5%, and what's the weight of the debt? 446, okay, give me the weighted cost of the equity. What's the weighted cost of the equity?
3.9.
And what's the weighted cost of the debt?
2.2.
2, and what's the total weighted average cost of capital? What is it? What is it? 6.1? That seems a little low. Seems a little low. On the low side, we probably underestimated the cost of the equity, or maybe the debt, or maybe our capital structures. But let's use 6. Okay. And what we'll probably do is you would probably run it at 5, 6, and 7. That would be your sensitivities, but we'll, for this purposes, we'll use the 6%. And the last cost we got 8. We use different assumptions. So now let's underwrite the deal, because now that we have the discount rate, we can now discount the deal. So the deal, right, is 1 million square feet. And the cost of construction is at least $1,000 a square foot, which means that the total cost of the development is $1 billion. And you also have done some market research and figured out that we can rent out this building at $100 a square foot in rent for a total gross potential rental income of $100 million. Now, we're probably gonna have to take out some kind of vacancy rate and some credit default. Some of our tenants may default. When we lease up this building, we're probably gonna give rent concessions, free rent. Some concessions. And we're probably gonna get some other income, particularly from the parking, and maybe other concessions. So if you take all of that into consideration, we're probably gonna end up with around $75 million in gross effective rental income. Now we gotta take out our expenses, because we have utilities, we got payroll, we got insurance, garbage, there's all kinds of expenses that we're gonna have to take into consideration. So after we take out the expenses, we're probably gonna end up with about $50 million a year in net operating income, or NOI. All right. And this is gonna be our T equals 0 cash flow. Now, to speed up the process, because I'm not gonna do a 10-year holding period, I'm gonna shrink it down to a 5-year holding period, but it doesn't really matter if you do a 10 or a 5, because the cash flows after year 6 or after year 11 is all reflected in the terminal value, okay? So you can either use 5 or 10. In our cases, in our shop, we usually use the 10-year holding period, but for this exercise, we're gonna use a 5, okay, for time. And what's our discount rate? Because we need to calculate the present value. So what's the discount rate that we're gonna use? What's the discount rate we're gonna use? What's the discount rate we're gonna use? What discount rate? I just spent like 30 minutes calculating the discount rate. What discount rate are we gonna use? What is it? 6%. Okay. So 1.06, and can you start calculating the discount factors for me? So what is 1.06 squared, 1.06 cubed, 1.06 to the fourth, and 1.06 to the fifth? Can you give me those discount factors?
Squared is 1.12,
Okay.
Cube is 1.19.
Are you guys verifying this for me?
yes.
Okay.
The fourth is 1.26.
Okay.
1.34.
Okay, excellent. So our base period net operating income is 50 million and T equals 0. How much net operating income growth do you think that we can get from the 1 year prior to in the first year of operations? How fast do you think we can grow the net operating income from 0 to 1? You've been doing this before, you've looked at these projects before, you've underwritten projects like this, so we basically know what the growth rate scenarios will be over the next 5 years or 6 years over the holding period. So what's the first year? What's the growth rate? Give me a number. Just give me anything. Again, I'm running out of time, so I need numbers.
6%?
6%? We can probably do better than that, but let's just use 6%. So what's 50 million times 1.06?
53.
53 million, okay. And then what about the second year? Year 1 to 2, what can we grow it out at? 5, okay, 1.05. So 53 million times 1.05.
55.65.
So let's just
Oh,
do
just
56.
56.
Yeah, just round up. Okay, and then from year 2 to 3,
4.
1.04, with 56 million times 1.04, 58. And what about from year 3 to 4?
30.
1.03, and then what's 58 million times 1.03?
60.
60. And then from 4 to 5?
2.
1.02, and what's 60 million times 1.02? 61 million, okay. Now, do we just take the present value of those cash flows to get the present value,
No.
compare it against the total cost to calculate the net present value?
No.
Is that how we do it? No, what do we do next?
Find your TBU terminal value.
Yeah, we gotta calculate the terminal value. TV, all right, now how do we get the TV? How do we get terminal value?
2 more years.
Yeah, we gotta go 1 more year, right? So we gotta go cash flow in T plus 6, okay? So what do you wanna grow the 5th year cash flow out by? We gotta go out 1 more year,
1%.
1.01, so what is 61 million times 1.01? It's like 62 or something?
Yeah.
62 million, okay. So now we got the cash flow for the 6th year, now what do we do to that to get the terminal value?
Find the discount rate of last year.
Well, the first question is do we want the cash flows to remain flat forever or to grow at a constant rate? Okay, and what model do we use? If we assume that the cash flows grow at a constant rate forever, what model do we use?
Gordon growth.
Gordon growth. So I minus G. Okay, so what's the constant growth rate gonna be? What do you wanna use? Well, if it's 0, you're using perpetuity, so it's gotta be greater, it's gotta be 1 or greater.
2.
Okay, 2, so 0.02. And then for the terminal discount rate, what do you wanna use? Do we use the going in discount rate or do we use something else? Do we use the going-in discount rate, or do we use something higher or lower or the same? Probably higher. Right? So how many basis points do you want to add to the going-in discount rate to reflect additional risk in the future? 3, I hear 3. 2. Okay, so it's what, 0.0678, so you're talking about 0.08 minus the 2, 0.06. So what's 62 million divided by 0.06?
1,033.
1,033, so 1,033,000,000. Okay, now what do we do with the terminal value?
Add it to the, right there.
So you add it to the last year of the holding period's cash flow. And how much does that come out to be? Was that 94? 1094? 1094, okay, excellent. So we got the cash flow for the last period in the holding period. So what's 1094 divided by 1.34? Now we need the discounted cash flow.
816.
What is it?
816.
816, that million? All right, and then what is 60 million divided by 1.26?
48.
What is it?
48.
48 million. How am I doing on time?
45 minutes,
How much?
45.
I can do it. All right. And what's 58 million divided by 1.19?
49.
49. Okay. And what's 56 million divided by 1.12?
50.
50. All right. And what's 53 million divided by 1.06?
50 again.
Okay. And what's 50 plus 50 plus 49 plus 48 plus 816? What does that give you for the present value?
1,013.
1,013.
13. Yeah.
And how much is the cost of the development? How much is it going to cost us to develop this?
1
$1
billion.
billion. And what's the NPV?
13 million.
13 million.
And you accept.
And we're going to accept it. All right. So the last piece, and it's funny because we ran this in other classes. Sometimes we had positives, sometimes we had negatives. Okay. So it was different depending on the assumptions that you made. So the last piece in the analysis is we are going to put together an investment decision-making matrix. Investment decision-making matrix. All right. And what we're trying to do here is to determine financial feasibility through the underwriting process. And that's basically what we're doing right now, is we're doing underwriting. Okay? We'll do underwriting on the securities, we're doing underwriting on the asset, okay, right now. And what we're gonna do first is lay out the investment decision-making matrix. Present value greater than the cost, present value equal to the cost, present value less than the cost. The net present value is positive, net present value is equal to 0, net present value is negative. Internal rate of return greater than the weighted average cost of capital. Internal rate of return is equal to weighted average cost of capital. The internal rate of return is less than the weighted average cost of capital. And in these large real estate assets, unlike company acquisitions, is our payback period is going to be longer. You know, in most tech companies, that develop new products, they're gonna be looking at break-evens of less than a year. When we're looking at companies to acquire, they tolerate break-even points no more than 3 years. And then on large assets like this, we may have break-even, it may take us 5 or 8 years to get there at some point. So in this case, let's just use a 5-year break-even. So if the break-even is less than 5 years, and then the break-even is equal to 5 years, and the break-even is, less than, greater than 5 years. Okay, now what we get to do, how much time do I have?
20 minutes.
I can do it. All right, so let's go through the first iteration, okay, the first iteration. And then I need full participation, okay, on this one. So everybody needs, it's like a sing-along, finance sing-along, just like the Sound of Music at the Castro. So as I go through these, you want to yell out, you know, accept or reject, okay? So when the present value is greater than the price, do you accept or reject it? Accept. I'm not hearing everything. When the present value is equal to the price, do you accept or reject it?
Accept.
Oh, that's better. Accept. When the present value is less than the price, accept or reject. Okay. When the net present value is positive, do you accept or reject? Accept. When the net present value is 0, do you accept or reject? Accept. Okay. And when the net present value is negative, do you accept or reject? Reject. When the internal rate of return is greater than the weighted average cost of capital, do you accept or reject? I didn't hear that.
Accept.
Okay. When the internal rate of return is equal to the WACC, do you accept or reject?
Accept.
When the internal rate of return is less than the WACC, reject. When the break even is less than 5 years, accept or reject? Accept. Okay, and the break even is equal to 5 years, accept. And when the break even is more than 5 years, do you accept or reject? Reject. All right. Now, bad news. We totally screwed up on the calculations. Actually, we went back and our growth rate assumptions were too aggressive and discount rates were too low. I think the discount rate was probably too low. And we came up with a negative net present value, okay? And if we get a negative net present value, do we accept or reject the project? So if we get a negative net present value, we are going to reject. Reject, and reject, and reject. And we really want this project. We really want this project. And let's say that the negative net present value in this case was on $1 billion project. Let's say negative 50 million. So it's, you know, we weren't totally far off, but we were pretty far off. So if we have a negative net present value of 50 million, what would be the first thing that we would do to get this project to be accepted? In this case, it's a development, okay? So we could probably go back and renegotiate the land price to get a price reduction. We could also go back and renegotiate the labor contracts. We could probably go back and renegotiate the material purchases to reduce the cost. And we could probably go back to the utility, to PG&E, and see if we could renegotiate the power purchase agreement with them to reduce the costs. So what amount of cost reduction would we need to be able to accept this project? The $50 million. Okay, so that's the first thing that we would do. Okay? But let's say we can't get the price reduction. What would we do now? No, not yet. Now, what could we do now? We go back to what? We go back and audit all the assumptions. So we would go back and we would look at what? the risk-free rate. Right, you can start yelling out the variables.
Cash flows.
You look at the cash flows, not only the level, but also maybe we underestimated the 50 million. You know, maybe we underestimated the revenue on the rents, maybe we underestimated the rents, maybe we overestimated the vacancies, maybe we overestimated the concessions, maybe we underestimated the parking revenue, maybe we overestimated the expenses. So we go back and look at all that stuff. Maybe we overestimated the risk-free rate, maybe we overestimated the risk premiums, maybe we overestimated the beta, maybe we overestimated the return on the market, maybe we overestimated the discount rate or the WACC, maybe we overestimated the terminal discount rate, maybe we underestimated the terminal growth rate, you know, to calculate the terminal value. So we would go back and look at all that stuff, okay? But let's say that we did that and we still have to reject the project because we're coming up with a negative $50 million in negative net present value. What do we do now?
Real call.
You calculate the real call option. Iteration 4 is going to be to calc. How am I doing on time?
14.
Got it. I got it. Easy. You calculate the real call option value. Where the book basically talks about the real call option value as a procedure in the investment decision-making process in chapter 20, okay, when it should be brought up front, okay? It should be brought up to chapter 8 or should be included in chapter 8 and 9 of those, okay? So that's why I'm going to get it and bringing it forward, because real call option valuations is part of the investment decision-making process, okay? So you have to include it. And real call option values, just so that you know, can be calculated by using a binomial tree, and they're also called lattice. I don't want to get into the technicals. And then the other one is the Black-Scholes model. Those two methods will give you the value of the real call option. Okay. So the factors involved, the factors that really drive real call option values, there are three. Can you give me the three? Can you tell me what the three are? Because I know I went over this. So what were the three main factors that drive real call option values? What are the three factors? Did you write the notes?
No.
Anybody have those notes? The first is time. The more time you have, the more time value there is in the real call option. So time. The other is optionality. Basically, you can, because you have such long time period, you can exercise this option at any time during that time period. And the ability to exercise the option has value. Okay. And optionality also, along with management decision making also adds value to the real call option, because we can manage the vacancy rate, we can manage the concessions, we can manage the expenses, we can time the market, we can negotiate the leases, we can manage the construction process, we can manage the entitlement process. We have a lot of touch points within the management process to add value to this, this project. So management decision. And then lastly is value volatility. Mission Bay is in ground zero, San Francisco, supply constrained, surrounded by the ballpark, UCSF, Central Business District, Caltrain. It has all of these amenities that no other location has. So the volatility and the valuations are highly sensitive to environmental changes. So the Bay Area, even though the values are really high and the returns are high, it's a very volatile market. Well, that volatility increases the probability that the call option will be in the money. So therefore, that volatility also adds value to the real call option. So the question is, if you run the real call option valuation, what does the value of the real call option need to be at a minimum to accept this project? It's gotta be 50 million. So if the real call option value is 50 million, then what is your net present value? So equal to 0, and you would accept. If you run the real call option value, and it comes up to be 25 million, what's your net present value? Negative 25 million. Then you would reject the project, and that's it. That's all you can do. That's all you can do. That's the last step in the iterative process that you could do to try to make this deal work. Because if you do the deal at negative 25 million, your internal rate of return is going to be less than your weighted average cost of capital. So you're going to have to take a lower return if you're willing to accept it. But if the hard hurdle rate is 6%, then that's it. Okay? I'm not going to take a 5% on this, or a 4. All right? So that's